Hi, you're a human. Congratulations on that, by the way. It's a mixed bag, but we're in it together. You wake up, probably to an alarm that you've snoozed at least twice because your brain is desperately negotiating for just 5 more minutes, like it's trying to broker a peace treaty with your mattress. You go to work. You trade your time, your actual life hours, the non-renewable resource, for money. Which, when you think about it, is kind of wild. You're literally exchanging pieces of your existence for colorful paper and digital numbers. But we'll get to why that's important. You get paid. And for about 12 minutes, maybe 15 if you're really savoring the moment, you feel financially stable. You look at your bank account and think, yes, I am a functioning adult. I have successfully adulted. I could buy a moderately expensive sandwich without anxiety. Then rent happens. That big chunk that vanishes faster than your motivation on a Monday morning. Groceries happen. And suddenly you're standing in the produce section wondering why a bag of organic spinach costs more than your childhood dreams. Fuel happens, because apparently your car runs on liquefied money. A random subscription you forgot about happens. Was it Spotify, that meditation app you used once, a streaming service for a show you already finished? Who knows? It's gone now. RIP $12.99. Maybe your car makes a weird noise. Not a "this can wait" noise, a "this sounds expensive" noise. The kind of noise that makes you turn up the radio and pretend you didn't hear it, even though you know it's going to cost you. And suddenly your bank account looks like it's going through a breakup. Traumatic, sad, empty, with a lot of "where did it all go wrong" energy. You're not irresponsible. Seriously, you're not out here buying yachts and gold-plated toilet seats. You're not cursed, though it might feel like it when your phone screen cracks the day after your warranty expires. You're participating in a financial system that most people never fully understand. And here's the kicker. They don't teach this in school. You learn the Pythagorean theorem. You learn that the mitochondria is the powerhouse of the cell. Very useful information if you're being held hostage by a geometry-obsessed biologist. But understanding how money actually works, how the economy functions, why your purchasing power feels like it's on a treadmill going backwards, nope, you're supposed to figure that out yourself apparently. And that system has rules, real, actual rules, not mysterious magic, not random chaos, rules. If you don't know the rules, you feel behind. You feel like everyone else got the instruction manual and you got a fortune cookie that just says, "Good luck, LOL." If you do know the rules, you start noticing patterns. Suddenly things click. You see why certain people make certain moves, why asset prices do what they do, why news that sounds scary might actually be predictable. And once you see the patterns, you stop panicking. You stop doom scrolling through financial news thinking the sky is falling every week. You start making decisions based on understanding, not fear. So today we're breaking down in excruciating, helpful detail why money loses value over time and why your grandparents could buy a house with pocket change, why assets keep getting more expensive, and why that's not actually a conspiracy, why the rich don't seem stressed about inflation. Spoiler, they're playing a different game. How investing actually works without the jargon that makes you want to take a nap. How to survive personally in this system, because knowledge without action is just trivia. And how the whole machine moves in cycles, so you can stop being surprised when it happens. All in simple language. No finance bro nonsense, no complicated equations, just clear explanations with some jokes because if we can't laugh about money, we'll cry about it. Let's start with the quiet villain, the thing that's robbing you in slow motion, inflation. The inflation game, why your money is basically melting. Okay, imagine a small country. Let's call it Moneyville. Very creative, I know. There are 1 million products in Moneyville. Apples, cars, houses, toothbrushes, those little stress balls shaped like fruit, all the things. And there are $1 million total in circulation. On average, everything costs $1. $1, one product. Beautiful, balanced, peaceful. The people of Moneyville are thriving. Bob buys an apple for $1. Susan sells a chair for $1. Everyone's happy. The economy is humming along like a well-oiled machine. Now the central bank of Moneyville, let's call them the money wizards because that sounds cooler, they decide, you know what, the economy needs stimulus, which is polite, fancy language for we're about to create a bunch of new money. Why would they do this? Well, maybe the economy is slow.
maybe people aren't spending, maybe businesses aren't hiring. The money wizards think if we create more money, people will spend more and everything will get moving again. Sounds reasonable, right? So now there are $2 million in Moneyville. They didn't print all of it as physical cash, more on that in a second, but the total money supply has doubled. But here's the thing. There are still only 1 million products. The country did not magically double production. The farmers didn't suddenly grow twice as many apples. The factories didn't pump out double the cars. The houses didn't multiply like rabbits. It doubled money, not stuff, just money. So what happens? Prices adjust. Because now Bob shows up to buy his apple, but he's not the only one with money. Everyone has more money. The apple seller sees all this money floating around and thinks, I could charge more for this apple. Now everything costs around $2. That apple Bob bought for $1 yesterday, $2 today. That share Susan sold also doubled. That's inflation. It's not complicated, it's not mysterious, it's not some evil plot, mostly. Inflation is what happens when the amount of money grows faster than the amount of actual stuff. More money chasing the same stuff, higher prices. Think of it like a concert. Limited tickets, unlimited people who want them. What happens? Prices go up. Scalpers get involved. Chaos ensues. Now here's where things people misunderstand. And this is important, so if you're eating a sandwich right now, put it down for a second. Actually, no, keep eating, but pay attention. Money is not mostly printed as physical cash. When you think printing money, you probably imagine some government facility with giant machines going brrrr, spitting out dollar bills. And yes, that happens, but that's actually a tiny fraction of how money gets created. Most money is created through lending. Mind blown, right? Here's how it works. When you take a mortgage to buy a house, the bank doesn't go to a vault, pull out someone else's pile of saved money and hand it to you. Nope. The bank creates a deposit in your account. Boom. New money enters the system. It's not coming from someone's savings account. It's being created digitally through the loan process. The bank is basically saying, here's $300,000 in your account. You owe us $300,000 plus interest. Good luck. Have fun. Don't screw this up. When businesses borrow money to expand, new money gets created. When governments issue bonds, basically IOUs, and central banks buy them, new money gets created. So the money supply expands through credit. Credit is just fancy talk for borrowing. Loans, mortgages, business financing, all of it. And credit expansion fuels economic growth. More money in the system means businesses can invest, hire people, build stuff. Growth happens. But, and this is the catch, it also fuels inflation if overdone. If too much new money floods the system too fast, prices rise because there's more money competing for the same products and services. It's like when a celebrity tweets about a restaurant and suddenly everyone shows up. The restaurant didn't get bigger, there's just way more demand. Prices go up. Wait times explode. Chaos. Now here's where things get really interesting, where the financial system starts feeling a little unfair. The unfair part. Why inflation hits you first and the rich last. When new money is created, it doesn't fall from the sky evenly like some kind of economic rainstorm. It doesn't land in everyone's pockets at the same time. It would be nice if it did. Imagine waking up one morning and there's just $10,000 in your account with a note, "Enjoy the economy." But no, new money enters through financial institutions, banks, large corporations, asset markets, stocks, real estate, bonds. This means asset prices often rise first. The people in institutions closest to where the money enters, they get to spend it before prices fully adjust. So what happens? Stocks go up. Wealthy investors in institutions buy equities, demand increases, prices rise. Real estate goes up. People with capital buy properties, developers get loans, housing prices climb. Private equity valuations go up. Big firms acquire companies at higher prices because borrowing is cheap. Consumer prices, the stuff regular people buy, groceries, gas, rent, they move later. It takes time for all that new money to trickle through the system and reach everyday goods. This is why inflation feels unfair, because it is a little unfair. If you own assets, stocks, real estate, businesses, inflation might actually benefit you. Your house value goes up. Your stock portfolio grows. You're winning. If you live paycheck to paycheck, inflation feels like a pay cut. Because your rent goes up, your groceries cost more, gas is more expensive. But your salary? That adjusts, maybe, hopefully. Because wages usually adjust slower than asset prices. Your landlord can raise rent pretty fast. Your boss giving you a raise, that's a whole production. Performance reviews, budget meetings, we'll see what we can do. So people with assets ride the inflation wave. People without assets get hit by it. That's the reality of how the system works. Not because anyone is evil, just because of how money flows through the economy. Understanding this changes how you think about money. Interest rates, the economy's gas pedal and brake. Now let's talk about interest rates, because they're basically the control panel for the entire economy. Interest rates are the price of borrowing money. Simple as that. When central banks lower interest rates, borrowing becomes cheaper. Think of it like a sale on loans. Get your mortgage at 3% instead of 7%, limited time offer. Cheaper borrowing means more people take out loans. More loans means more money circulating in the economy. More money chasing assets means higher asset prices. So low rates inflate markets. Housing booms, stock market goes up, everything feels good. People refinance, businesses expand, jobs get created. It's like turning up the heat in your house. Things warm up. High rates cool markets. When central banks raise interest rates, which they do to fight inflation, borrowing gets expensive. That 3% mortgage, now it's 7%. Your monthly payment just almost doubled. Ouch. Business loans get expensive. Companies think twice about expanding. Do we really need that new factory? Maybe we'll wait. Spending slows. People hold on to their money more tightly. Asset prices often fall. Why? Because if you can get 5% risk-free from a savings account, why would you put your money in stocks that might crash? The competition for your capital increases. So central banks constantly balance growth and inflation. It's like they're driving a car where the gas pedal is money printing and the brake is interest rates. Too much gas, the car overheats. That's inflation. Too little brake, the car stalls. That's a recession. They're trying to keep the car moving at a nice, steady speed without crashing or breaking down. Too much money in the system, inflation starts rising. They hit the brakes, raise rates. Too little money, economy slows down, people lose jobs. They hit the gas, lower rates. They're walking a tightrope, a really, really important tightrope. Because if they mess up too badly, either we get runaway inflation, your money becomes worthless, or a massive recession, everyone's broke and unemployed. No pressure, money wizards. The debt machine, why modern economies run on borrowed money. Now here's the deeper layer, the thing that keeps the whole system running. Modern economies are debt-driven. This sounds scary, but stick with me. Governments run deficits. They spend more than they take in through taxes. The difference? Borrowed money, government bonds. Corporations borrow to expand, to invest in research, to build factories, to hire people. Cheap borrowing fuels growth. Consumers borrow, mortgages, car loans, credit cards, student loans. We borrow to buy homes, get educated, start businesses. Here's the thing. If credit stops expanding suddenly, the system contracts. Imagine tomorrow, all borrowing just stopped. No new mortgages, no business loans, no credit cards. What happens? People stop buying houses, real estate crashes, businesses stop expanding, hiring freezes, layoffs happen. Consumers stop spending, stores close. That contraction feels like a recession. Actually, it is a recession. So policymakers often prefer gradual inflation over sudden collapse. They'd rather have prices rise 2 to 3% per year than risk the entire system seizing up. It's not ideal, but it's the trade-off. Slow erosion of purchasing power versus sudden economic disaster? They pick slow erosion. And honestly, if you understand the game, slow erosion is manageable. You just have to know how to position yourself. Which brings us to labor versus capital, the two roles in the financial game. Now that you understand inflation and money creation, let's talk about positioning. There are two primary roles in this system, labor and capital. Labor works for money. You show up, you do the work, you get paid. Your time equals money. This is where most people live. It's not bad. It's necessary. Someone's got to do the actual work. But here's the limitation. Your income depends on your time. You only have so many hours in a day. If you don't work, you don't get paid. Capital owns assets that generate money, stocks that pay dividends, real estate that generates rent, businesses that produce profit, bonds that pay interest. When you accumulate capital, your money begins producing income. You make money even when you're sleeping, even when you're on vacation, even when you're binge watching a show about competitive baking. The goal isn't to quit your job tomorrow, unless you hate your job, in which case maybe explore that. But for most people, the goal isn't immediate escape. The goal is gradual ownership. Over time, you shift from relying entirely on labor income to building capital income. You don't have to go from zero to millionaire overnight. You just have to start moving in that direction. Think of it like this. If you're 100% labor, you're on a treadmill. You stop running, you stop earning. If you're 90% labor, 10% capital, you're on a treadmill with a gentle tailwind helping you along. If you're 50-50, you've got options. If you're 10% labor, 90% capital, congrats, you've basically won the game. The shift from consumer to owner changes everything. But to do that, you need to understand assets. Understanding assets, where your money goes to grow. Let's break down the major asset types. Without the boring textbook definitions, just what you actually need to know. Stocks, tiny pieces of real companies. Stocks represent ownership in companies. When you buy a share of Apple stock, you literally own a tiny piece of Apple. Not enough to walk into their headquarters and demand free iPhones, but still, you're an owner. Companies aim to generate profit. They do this by increasing revenue, selling more stuff, improving efficiency, doing things cheaper, faster, raising prices when they can get away with it, innovating, making new products people want. If profits grow, company value grows, and if company value grows, the stock price goes up. Stock prices reflect expected future profits, not current profits, future profits. This is why markets move on expectations, not just current results. If a company beats expectations, stock goes up. If a company misses expectations, even if they're still profitable, stock might go down. It's all about future potential. This is also why markets seem crazy sometimes. A company announces bad news and the stock goes up. Yeah, because the bad news wasn't as bad as people expected. Expectations are everything. Long-term stock growth is tied to productivity. As technology improves and output increases, corporate earnings expand over time. Companies get better at making things. They automate, they innovate, they find efficiencies. That's why historically, broad markets trend upward over long periods. Not smoothly, not predictably, not without terrifying drops that make you question all your life choices, but upward. Over 10, 20, 30 years, markets have historically gone up. Because human productivity and innovation tend to increase over time. We get better at stuff. Real estate is the asset you can actually touch. Real estate values are influenced by land scarcity. They're not making more land. Unless you're the Netherlands, they're doing something wild over there. Population growth. More people equals more demand for housing. Income levels. If people earn more, they can pay more for homes. Interest rates. This is huge. When rates are low, more people can afford mortgages. Demand goes up. Prices rise. When rates are high, fewer people qualify. Demand drops. Prices stabilize or fall. Construction costs. If building materials get more expensive, existing homes become more valuable. Why build new when you can buy existing for less? Real estate is heavily influenced by credit conditions. Cheap credit often leads to housing booms. Everyone's getting mortgages. Flippers are flipping. Developers are developing. Prices go wild. Expensive credit cools housing markets. I'm not paying 7% on a mortgage. I'll just rent forever, thanks. Real estate is interesting because it's both an investment and a place you actually live. So there's emotional value plus financial value. Your house is appreciating, but also you can't sell it without having to move. So it's kind of illiquid capital. Still valuable, just complicated. Bonds are the boring but stable friend. A bond is a loan. You lend money to a government or corporation. They pay you interest over time. At the end, they give your principal back. Government bonds are considered very safe because governments can always pay you back. They have taxes. They have printing presses, kind of. Corporate bonds are riskier. Companies can go bankrupt, then you're out of luck. So corporate bonds pay higher interest to compensate for the risk. Bond prices move opposite to interest rates. This confuses people, so let me explain. You buy a bond paying 5% interest. Then interest rates rise and new bonds pay 7%. Your bond is now less attractive. Who wants 5% when they can get 7%? So if you tried to sell your bond, you'd have to sell it for less than you paid. Price goes down. When rates fall, existing bonds gain value. Your 5% bond looks great when new bonds only pay 3%. Everyone wants yours. Price goes up. Bonds offer stability, lower returns than stocks generally, but lower volatility. They're not going to make you rich, but they're not going to make you panic sell at 2 a.m. The most powerful concept: time is your superpower. Now here's the most powerful concept in all of finance, the thing that turns small amounts into large amounts: compounding. If you invest and reinvest returns, your growth accelerates over time. Let's say you invest $1,000 and it grows 10% in year 1. You now have $1,100. Year 2, you earn 10% again, but now it's 10% of $1,100. You earn $110, not $100. You end with $1,210. Year 3, you earn 10% of $1,210. You get the idea. Early growth feels slow. You're like, cool, I made $100. I can buy a decent dinner. Later growth feels exponential. Suddenly, you're making thousands per year without doing anything. Time multiplies discipline. This is why starting early matters so much. The difference between starting at 25 versus 35? Enormous. That extra 10 years of compounding can literally mean hundreds of thousands of dollars. You don't need to be a genius. You don't need to pick winning stocks. You just need to start, stay consistent, and let time do the work. Compounding is the closest thing to magic in finance. Survival mode: how to actually make this work. Now let's shift to survival, because theory is great, but you need practical steps. Before investing aggressively, stabilize your foundation. You can't build wealth on quicksand. Kill high-interest
debt first. High-interest debt destroys wealth. If your credit card charges 25% interest, that's negative compounding working against you. Every dollar you owe is costing you 25 cents per year. Meanwhile, the stock market averages about 10% per year historically, so you're losing 25% while trying to gain 10%. The math doesn't math. Pay off high-interest debt before you invest aggressively. Mortgages and student loans at low rates? Those are different. You can carry those while investing. But credit cards? Car loans at 15%? Nope. Kill those first. Build an emergency fund. Emergency funds protect you from forced decisions. Imagine the market crashes 30%. Your stocks are down. Then your car breaks. If you don't have an emergency fund, you're forced to sell your investments at the worst possible time. You lock in losses. If you have an emergency fund, you pay for the car repair and your investments can stay put and recover. Liquidity equals flexibility. Most experts recommend 3 to 6 months of expenses saved. Is that easy? No. Is it important? Absolutely. Beware lifestyle inflation. Lifestyle inflation is a silent wealth killer. You get a raise. Great. So you upgrade your car, move to a nicer place, start eating out more. Income rises 25%, spending rises 25%. Net progress? 0. Actually, negative. The trap is that the more you earn, the more you feel you deserve to spend. And you're not wrong, you do deserve nice things. But if spending rises as fast as income, you never build capital. The goal is to let your income grow faster than your expenses. Keep expenses relatively stable even as income rises. The gap? That's where wealth comes from. Invest in your earning ability. Your earning ability is your first asset. The higher your income, the more capital you can accumulate. Skills matter. Credentials matter. Networking matters. If you can increase your income from $50K to $80K, that extra $30K per year invested becomes serious money over time. Don't just focus on investing your money, invest in yourself. Take courses, learn skills, switch jobs strategically, negotiate salary. Your career is the engine that funds everything else. The psychology. Why humans are terrible at money. Now let's talk about behavior. Because here's the thing. Humans are not rational calculators. We are emotional, biased, irrational creatures. And the financial system knows this. Loss aversion. We fear losses more than we value gains. Losing $1,000 feels way worse than gaining $1,000 feels good. This makes us do dumb things. We hold losing investments too long, hoping they'll recover.
We sell winning investments too early, afraid of giving back gains. Herd mentality. We follow crowds. When everyone's buying crypto, we want in. When everyone's panicking, we panic. This is why bubbles form and crashes happen. Everyone buys at the top, then everyone sells at the bottom. Recency bias. We assume recent trends will continue. Market's been going up for 2 years, must keep going up forever. Market crashed, must keep crashing forever. Neither is true, but our brains think this way. Overconfidence. We think we're smarter than we are. We think we can time the market. We think we found the next Amazon. Statistically, most people can't beat the market consistently, but we all think we're the exception. This creates volatility. Disciplined investing often means doing the opposite of emotional instincts. When fear is high, when everyone's selling, valuations are often lower. That's when things are on sale. When excitement is extreme, when your Uber driver is giving you stock tips, risk is often higher. That's when you should be cautious. Understanding this doesn't make you immune to emotions, but it helps you recognize when you're being emotional. And that recognition, that's where good decisions come from. Cycles, the economy's rhythm. Understanding cycles prevents panic. Economies expand and contract. It's not random, it's rhythmic. Expansion brings optimism. Jobs are plentiful, wages rise, spending increases, markets go up. Everyone feels like a genius investor. Recession brings fear. Jobs get cut, spending drops, markets fall. Everyone feels like the world is ending. But here's the thing. Recessions are normal. They're part of the process. They're how the economy clears out excesses. Central banks respond with interest rate adjustments and liquidity measures. Rates get cut, money gets injected, support programs get rolled out. Liquidity injections often lead to asset rebounds. Money floods back into the system. Markets recover. Tightening cycles often cool overheated markets. Rates rise, money becomes scarce, speculation dies down. These cycles repeat in different forms. Different triggers, different players, same basic pattern. Understanding them reduces surprise. You stop thinking, oh no, a recession, this has never happened before, and start thinking, a recession, expected, temporary, opportunity. That mindset shift is everything. The big picture. What this all actually means. Now zoom out to the big picture. The financial system is not personal. It's not targeting you. It's not conspiring against you. It operates on incentives. It rewards productivity. Make things, solve problems, add value. You get compensated. It rewards ownership. Buy assets, they grow over time, you accumulate wealth. It rewards patience. Compounding takes time. Discipline pays off. It punishes over-leverage. Borrow too much at the wrong time, you get wiped out. It punishes emotional decisions. Panic sell, FOMO buy, you lose money. It punishes stagnation. Just holding cash, inflation eats it. Inflation erodes idle cash. Money sitting in a checking account loses purchasing power every year. Assets adjust over time. Stocks, real estate, businesses, they adapt to inflation. Their prices rise with the money supply. Debt magnifies outcomes, good or bad. Borrow to buy assets in a rising market, you multiply gains. Borrow to buy things that lose value, you multiply losses. Opportunities create cycles. Downturns are when assets go on sale. If you have capital when everyone else is panicking, you win. If you only trade time for money, inflation feels like constant pressure. Your dollars are worth less each year. Your rent keeps rising. Everything feels harder. If you gradually accumulate productive assets, inflation becomes less threatening. Your stocks rise, your real estate appreciates, your business grows. Inflation might hurt your cash, but it helps your assets. The shift from consumer to owner changes everything. You stop asking, why is everything so expensive? And start asking, what assets benefit from this environment? You stop reacting, panicking, complaining, feeling victimized. You start positioning, strategically moving your resources into assets that benefit from the current economic environment. And positioning compounds. Just like investments compound, good decisions compound. Every smart move makes the next one easier. The system isn't designed to make you broke. It's designed around incentives. Understand the incentives and the outcomes make sense. Ignore them and everything feels random, like the universe is just messing with you for fun. The real conclusion, you're not powerless. Now you know the rules. And once you know the rules, you can play strategically instead of emotionally. You understand inflation isn't random. It's a feature of the money supply growing faster than production. You understand interest rates control the flow of credit and influence asset prices. You understand the difference between labor and capital and why building capital matters. You understand assets, stocks, real estate, bonds, and how they respond to economic conditions. You understand compounding and why time is your biggest advantage. You understand cycles and why crashes are temporary and recoveries are inevitable. You understand behavior and why discipline beats emotion. That's the financial system. And now it's not mysterious anymore. It's not some dark magic that only the rich understand. It's a system. With rules, with patterns, with opportunities. You're not powerless. You're not doomed. You're just at the beginning of understanding how the game actually works. And understanding, that's the first step to winning. You don't need to become a Wall Street trader. You don't need a finance degree. You just need to understand the incentives, position yourself accordingly, and let time do the heavy lifting. Start small. Learn constantly. Stay disciplined, and slowly, very slowly, you shift from being pushed around by the system to using the system to build the life you actually want. That's it. That's the game. Now, go play it.